Alright guys, welcome back to the channel. Today, we're going to tackle a topic that can seem intimidating, but is completely essential if you want to build real, long-term wealth in real estate. How interest rates affect your investments. We're going to break down how the decisions made in a boardroom by the Federal Reserve impact what you pay on a mortgage, what your home's value is, and what tactics you should be using. Stick with me, because you'll know the market in a whole new context by the time you leave here. And so, it starts here, with the Federal Reserve, really America's central bank. The Fed is not just randomly changing rates for fun, however. They are working under what is known as a dual mandate. Think of these as their two main jobs. First, they have to provide maximum employment. They want each individual who is looking for work to have a job. And second, they have to keep prices stable, or more polite language for it, they have to control inflation. They make every single one of their interest rate choices attempting to balance these two goals. When they see that the economy is booming and prices are rising too fast, they put the skids on and remove stimulatory elements by hiking interest rates. And that action, my friends, is what sends shockwaves through the housing market. This is the Fed's most powerful tool, also known as the Federal Funds Rate, or FFR. This is not your mortgage rate. This is the rate banks charge each other for overnight loans. There's a committee of the Fed, the FOMC, that gets together 8 times a year and decides where to place this rate. They take the economy into account, they take inflation into account, and then they decide. And this decision is akin to throwing a big rock into a pond. The ripples ripple out everywhere, from the interest on your credit card to, you guessed it, the cost of borrowing money to purchase a house. It sets the tone for the whole cost of capital in our economy. But there are occasions when reducing that single short-term rate for that momentary instant is not enough, especially during a crisis. So the Fed deploys the big guns with a policy called quantitative easing, or QE. That's when the Fed essentially prints fresh cash to buy huge amounts of long-term government debt and, crucially to us, mortgage-backed securities. By causing gargantuan demand for such securities, they reduce their yields. And since mortgage rates are determined by such yields, QE has the direct effect of lowering the price of taking a mortgage to all. It's if the Fed is flooding the financial system with inexpensive money, and a lot of it gets invested in property, boosting demand, and subsequently, house prices. Okay. So what happens when the party's over and inflation gets out of hand? The Fed does the exact opposite, a policy known as Quantitative Tightening, or QT. This is the process of reversing QE. The Fed stops reinvesting the money it gets from its maturing bonds and mortgages, effectively pulling that money out of the economy. It's like sucking gas out of the engine. It reduces liquidity, makes money harder to get, and directly raises long-term interest rates. And this is where it gets important for us. By having mortgages a part of this mechanism, the Fed is directly making borrowing to purchase a home more expensive. They are directly trying to get the housing market to slow down to fight inflation. And the scary part? The Fed is politically independent in structure, meaning they're going to keep putting this pressure on, though it hurts asset prices, until they fix the problem of inflation. So why does it all ultimately show up in the actual mortgage rate you see on the website of a bank? It all comes back to one outlier benchmark, the 10-year Treasury note yield. This is what you get for lending money to the U.S. government for 10 years, and it's the risk-free rate. This is what lenders set their standards by. When the yield on this ultra-high-grade 10-year bond rises, then lenders have to charge increasing interest rates on mortgages in order to make them attractive to investors. Why on earth would you venture out and buy a high-risk mortgage if you can get as much money from the U.S. government? So when you see the 10-year Treasury yield increase on the news, rest assured that mortgage rates are going to follow suit. This is your compass for where costs of funding are headed. And this doesn't happen in isolation. The policy of the Fed has to pass through the banking system before it gets to you. When the Fed raises rates, banks find it more expensive to raise funds. Banks, however, are smart. They do not always pass each and every rise fully to consumers. They can tinker with their deposit rates or shift between sources of funding. But when tightening is rapid, something devious can happen, known as yield curve compression, in which short-term costs for banks rise faster than long-term rates. When that happens, to remain profitable, they have to increase the spread, i.e., they have to push up mortgage rates even higher than the 10-year Treasury would suggest. So, the banking system at times supports the Fed's actions. This higher rate climate affects different kinds of properties in different ways. Residential mortgages, like on a single-family home, are less costly since they usually have government backing. But for commercial property, like apartment houses, office buildings, or retail facilities, the rates are typically much higher. We're generally referring to 0.5% to a full percent above residential rates. And it gets more complicated. A good, unlevered apartment building will get a rate of, for example, 6 or 7%. But a riskier asset, for instance, an underperforming shopping mall, will see rates soar into the teens. The riskier the asset, the more bucks. Which brings us to the age-old investor's question, fixed or adjustable? A fixed-rate mortgage gives you security. Your rate is locked in for the duration of the loan, which is perfect for your budget, especially when you can lock a low rate. But you generally pay a premium for that stability in the way of a little higher initial rate. An adjustable rate mortgage, or ARM, starts low, maybe much lower, for a few years. 5 or 7 years, say. Then it starts to follow along with the market. In a high-rate environment such as we have today, astute investors might use an ARM as a calculated bet. They're short-term risking, hoping that when their loan is up for renewal, rates have come back down to more favorable levels, and they can refinance into a cheaper fixed mortgage. Let's get to the bottom line of how these rates impact your pocketbook. It all comes down to 3 key metrics. One is net operating income, or NOI. It is just your rent coming in minus all of your expenses to operate the property before you pay your mortgage. It's a measurement of how well the actual property is performing, regardless of how you financed it. You then have cash flow. This is what money you actually get to keep. It's your NOI minus your annual debt service, your mortgage payments. As the rates go up, your debt service skyrockets and your cash flow can evaporate overnight. Finally, there is cash-on-cash return, your annual cash flow, divided by the actual cash you invested. That tells you the strength, or risk, of leverage. There is, however, one metric lenders care most about, the debt service coverage ratio, or DSCR. This is the large gatekeeper of obtaining a loan. The formula is simple. DSCR is your net operating income divided by your annual debt service. You must have a cushion, typically a ratio of 1.25 or higher. That's to say, for every dollar of mortgage you carry, the property is generating $1.25. Now consider what happens when interest rates rise. Your debt service payment goes up. Even if your NOI is still as level as a playing field, that ratio drops. If below 1.0, you're in negative cash flow territory. A declining DSCR can hinder your ability to get a new loan, trigger loan covenants, or even necessitate you putting in more capital into the property. It becomes the single number that cares most about being on your loan application. This really highlights the two-edged sword quality of leverage. When interest is low, borrowing cash is a superpower. You can leverage your profits and build a portfolio in a much shorter time. But when rates go through the roof, that same leverage is now acting against you. The debt which had been powering your profits now starts to power your losses. That monthly payment, so conveniently planned, now becomes a huge drain, tightening your cash flow and jeopardizing your whole investment. Leverage makes the positive and the negative happen twice as much. So on top of your monthly payment, higher rates directly assault your property's value. Real estate is valued on a multiple of what it earns, on a formula known as the capitalization rate, or cap rate. The formula is simple. Property value equals NOI divided by cap rate. But what the heck is a cap rate? It's actually the return an investor would expect for buying the property outright. And here's the key point. That expected return consists of 2 elements. The risk-free rate, that 10-year Treasury yield we were talking about, plus a risk premium for all the aggravation of owning real estate. And here's the key connection. When the 10-year Treasury rate goes up, the risk-free rate goes up. So that means that investors' required rate of return on everything has to go up. So cap rates must widen or go up to compensate for it. Now let's look at that value formula again. Value is NOI over cap rate. If your cap rate rises and your NOI is unchanged, the only mathematical result is a lower property value. It's not up for debate. That's the simple explanation why rising interest rates cause falling property values. The market is demanding a higher return, and the only way to get that greater return from a fixed income stream is by paying a lower price for it. This math creates a ruthless standoff in the market. On the one side, you have buyers who are working with the new numbers in cap rates and are now cutting their offer prices instantly. On the other side, you have sellers who are emotionally stuck on what their property was worth 6 months or a year ago when the market was at its strongest. The seller believes that the buyer is attempting to steal the property. The buyer believes that the seller is crazy. This core clash of expectations is precisely why transaction volume simply drops off a cliff during hyper rate hiking cycles. The market essentially freezes. Now, lots of folks watch these high rates and think to themselves, I'll just wait till they fall before I purchase. Too often, this is a tremendous and expensive mistake. Consider the following. While you sit on the sidelines waiting for maybe 0.5% reduction in rates, home values are still appreciating behind the scenes. Let's assume they rise by only 5% annually. On a $500,000 property, that's an extra $25,000 higher price. So even when you finally do get a bit better rate, you're taking out more money on a more expensive property. Quantitative math always shows that the compounded cost of waiting for the price to drop almost always far outweighs the benefit of a bit lower rate in the future. Time in the market almost always beats timing the market. What do you do when bank funds are too expensive? You get creative. One tough option is seller financing, where the person selling you the property essentially becomes the bank, generally for a price less than you would find anywhere else. Another is establishing equity partnerships. You supply the expertise, a partner supplies the capital, and you reduce immediately expensive debt. And you can also use blanket mortgages to package several properties into a single loan, which may get you qualified for a better overall interest rate. And don't overlook the lease options, in which you can own a share of property and its cash flow without even getting approved for an ordinary mortgage upfront. You also have to adapt by focusing on the right kinds of assets. Multifamily residences like duplexes, triplexes, and small apartment buildings are kings in a high interest rate world. They have several income streams, which equals stability. And more importantly, smaller multifamily homes will continue to qualify for lower residential mortgage rates, which is a colossal arbitrage opportunity compared to commercial loans. This is the foundation of house hacking. Also, higher rates cause distress. People can't afford their mortgages, leading to forced sales. This is where distressed investing opportunities start, for you have the chance to acquire properties below market. But this distress also means the largest risk and opportunity waiting in the wings: the commercial refinancing wall. Look at all the properties acquired with cheap 5-year commercial loans from 2018 to 2021. Those loans are maturing, and when the owners return to refinance, they're facing rates 2 or 3 times higher than they had. For most, the new higher debt payment will be more than the property's income can support. Their DSCR will implode. This will create a tide of distressed sales, offering phenomenal opportunities for investors who have cash and are ready to act. All of this dictates a radical strategic reorientation. Back in the cheap money days, the aim was usually to jack up your IRR, your internal rate of return, by betting large on appreciation with huge leverage. That game is up. In a high-rate environment, prosperity is no longer about speculative appreciation. It's about cash yield. Your attention has to shift to purchasing recession-proof assets that generate strong, stable, immediate cash flow. You need to value operational excellence above all. Decrease your dependence on debt and get your DSCR up to a level where it can ride out the storm. The investors who will thrive are those that value certainty and cash flow above all else. And so in short, Interest rates and real estate are one and the same. Your Fed policy dictates the cost of capital, which dictates property value via cap rates and your viability via the DSCR. To win, you have to be defensive, creative, and laser beam focused on cash flow. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.